let's talk about how you can choose the right mutual fund for you. It's an important choice, and to help you make that choice, I've got with me Santosh Navlani, who's the Chief Operating Officer of ET Money. Santosh, thanks so much for joining in as always. Let's talk about the first and most important aspect that you need to bear in mind, which is why are you buying a particular product, right? Or why are you investing in a particular scheme? That's the first questions that investors should answer, right?
Yes. Hi, Alex. Yeah, basically, you always need to bear in mind that whenever you're investing for something about in your life about your future. If you invest with objective in mind, you will probably be able to construct your portfolio in a far objective manner than actually buying a random set of funds or random set of schemes or even direct equity for that matter. So, keeping in mind the objective helps you decide what's the right plan one can lay down to reach that objective. And in that plan, you would actually be knowing how should I construct my portfolio? Should I be having a safety more prioritized over capital appreciation, or I should prioritize capital appreciation more over safety? All these things will be answered only when you know the objective behind it and when that objective is supposed to get achieved. So, if you're putting in an objective of, say, investing for children's education, which may be 10, 15, 20 years away, you would be having time on your side, and you would actually be prioritizing capital appreciation more over the safety of your principal capital, irrespective of your horizon. You may kind of put more weightage to safety and less to capital appreciation, but everybody would always be having some weightage to capital appreciation as an objective towards that goal. And when you're investing for short-term horizon, like building an emergency fund, or building something for your savings towards paying for your home loan down payment, or for that matter, buying a dream car for yourself, which may not be way too distant in the future, but maybe a couple of years down the line, you would always be forced to prioritize safety of capital more instead of capital appreciation. So, having an end objective in mind, having a time horizon towards that objective will always be helpful in deciding what kind of asset you should be owning, and it's the most critical aspect of planning, in my opinion.
Once you've decided why you need something, you need to come to the next important point, which is what will help you achieve that goal. And this is essentially the purpose of today's conversation. Let's first talk about equity mutual fund schemes, and then we'll move to debt funds. And finally, we'll talk about a few things that you can bear in mind for passive funds. But first, for equity funds, obviously you're looking at performance, right? But what governs performance, Santosh?
Yes, so I think equity is all about investing towards future possibilities that your country of residence has. So, if you're investing in India, you are actually investing for India's future, or getting your money invested in India's future. So, obviously, you will be kind of expecting that your money should grow as long as India continues to grow, and hence equity is one of the best ways to achieve that. You're investing in businesses which actually are investing in capacities to produce goods and services which can be delivered to end users at a profit. That profit gets reinvested in building the business further, and a growth cycle begins from there. And similarly, if you're invested in that business, you will actually be kind of partly owner by, even via investing in mutual funds, you own some piece of the business in very, very indirect manner, and all the growth will come to your portfolio in that sense. So when you're investing in equity, you're investing for the future, and that future is all about growth of businesses in the country. And one of the best ways is to actually buy a diversified mutual fund, or maybe an index fund, which actually can mimic that growth for yourself.
But if you're talking about the performance metrics, the tendency, Santosh, is to look at past returns, and that's not really the best way to identify the right mutual fund scheme for you, because especially if you're looking at a point to point return, it could in fact mask a lot of issues that could be hidden beneath the surface. So, what can you tell us in terms of a few things that an individual can pay attention to, the retail investor can look at in terms of performance of equity mutual fund schemes?
Uh, so Alex, it's a slightly tricky thing to kind of decide what kind of performance benchmark you should be looking at. So if you're looking at investing in equity, there are multiple combinations possible there. Whether you are a large cap investor or a mid cap investor or a small cap investor or diversified investor having assets across market caps, understanding performance, you need to first understand which category you as an investor belong, or which category you want to invest in. So first of all, it's important that what you're evaluating, you should not evaluating a one scheme against all 2000 funds available in the market. You basically are evaluating one fund against its category or similar kind of funds in the marketplace. So first thing to keep in mind is that you should not evaluate or compare performance of a small cap fund with a large cap fund. You should not be comparing performance of a hybrid equity fund with that of an index fund or a large cap mutual fund, even a diversified flexi cap, multi cap mutual fund. So first thing in mind is compare apples to apples, not apples to oranges. Second aspect, once you are zeroed down on the category that you are evaluating a mid cap fund or evaluating a large cap fund or a flexi cap fund, look at least three parameters. One is you should look at whether the fund is beating the benchmark consistently or not. If the fund is not beating the benchmark, then it's not doing the job. And you're far better off by probably putting money in a passively managed mutual fund, which is replicating the same kind of objective that this fund is doing. So, for example, if you're investing in a large cap fund and the fund is not beating benchmark, you should be actually investing money in Nifty 50 or a Nifty 100 kind of index fund, and so on and so forth for mid cap and small cap and flexi cap like a Nifty 500 index fund. If you second aspect to look at beyond benchmark is category average. So in a bull market kind of scenario, almost everybody performs really well. Everybody probably tends to beat the benchmark. Now, by looking at category average and fund performance, you actually get to know whether it was very easy to beat the benchmark for everybody, and hence everybody is able to beat it. But very few people are able to beat category average because that level of supreme performance is only done by a coveted few funds. So you can basically separate the real winners from the consolation prize winners, which is everybody is beating the benchmark in that sense. So look at category average. The fund that you are choosing should actually have beaten the category average consistently as well, over 1 year, 3 year, 5 year periods, and maybe annual as well. Third piece beyond beating the benchmark, beating the category average, is how consistent the fund's returns are. And one of the best ways to understand whether the fund's returns are consistent or not, or basically the fund is actually able to demonstrate great performance not just in bull markets but in bear markets as well by falling less, is rolling returns. What does rolling return actually mean is sometimes get tricky to understand for people. Just to simplify it, it basically means that if there was a 15-year period of performance available for evaluation, you can basically look at uh, different 1 year periods, different 3 year periods, different 5 year periods within these 15, 20-year history available, and look at what is the average return given in these 1, 3, 5 year periods. So, for example, if you're looking at a 5 year period and you're looking at data from, say, 1st of January 2006 till date, you would probably be looking at 16 years plus of data. And one of the ways to break down this 15 years into multiple 5 year periods is look at data for 1st January 2006 till 31st December 2010, then 2nd of January 2006 till 1st of January 2011, then 3rd of January 2006, and so on and so forth. So you'll probably get hundreds and thousands of 5 year periods, and you basically take an average of multiple 5 year period returns. What you will get is something that is a good predictor of what you can earn in the future. And rolling returns have one more depth. After this analysis that you do, you basically look at, if my return expectation is at least 8% or 10%, what is the probability of the fund or the category to give you a return in these 5 year rolling year periods beyond that benchmark of 8 or 10%. And if the probability looks like upwards of 80, 85%, you are rest assured that you're choosing a good fund, a nice, consistent fund, and you can go ahead with that. So three things: category average, benchmark performance, and rolling returns put together can give you very good understanding of funds return outcomes, and you can prioritize that.
A couple of other things also, right, Santosh, because if you're talking about actively managed funds, the kind of churn that you see in a portfolio is important to look at, and the what comprises that portfolio must also be looked at, right? So, is it necessarily a bad thing that there's a lot of churn? Because there are some mutual fund schemes which have seen significant churn, but have still managed to give you a massive return.
Yeah, so I think there are multiple investing themes available, Alex, and every fund house will have its own philosophy. Too much churn can actually be detrimental by creating a lot of cost in the portfolio because there will be brokerage cost, depository charges, and things like that. You'll end up basically paying for the trading as well with the fund managers doing for your money. But sometimes some fund managers do a pretty good job of doing multiple short-term investments and creating returns of it. So there's nothing wrong in that, I would say. If the fund is able to demonstrate that no high churn given performance or performance from high churn, then the fund may be having something up its sleeve which nobody is able to else demonstrate constantly. But given that we invest for long term, and in the long term, multiple kind of strategies work in different time periods, and what is more consistent in this is basically having a fixed approach towards investment, which is basically bottom up stock picking, or investing in good businesses which have proven their performance and profitability, or basically buying an index fund which actually by definition puts only decent large companies into the index, and you're able to get beneficiary out of this. So an investor will never basically have control on the portfolio turnover ratio, as it's called, by looking at past performance of the fund. It's about whether you can actually look at the benchmark beating category average and rolling returns. If that is satisfying your performance, you should look at. I would actually add another risk parameter beyond portfolio turnover ratio is basically like what is standard deviation of returns. So if the if the variance or the variation that you can expect in returns between minimum return you expect over a given period of time and the maximum return that the fund has given a period of time, if that range is larger, then you may become victim in the future about falling in a range which is falling on that part of range which becomes very undesirable place to be in. So for example, if a fund has given 15% return and the standard deviation of returns for that fund is about say 11%, what it means is as an investor you may get 26% return, or you may also get like 4% return. Mostly you'll get 15, but there are periods where you get about 4% and you'll be period about 26%. So if you end up falling in a cycle where you are getting returns towards 4%, maybe 4, maybe 5, maybe 6, then you know that you may get a victim of bad timing in that case. So investing in funds which actually demonstrate lesser variation returns and lesser standard deviation is far more desirable than investing in a fund which is having very high standard deviation.
Just a further point on that standard deviation point, of course, you're talking about different categories having different acceptable levels of standard deviation, right? How do you determine that? Does it only come with experience, or are there acceptable values that you can look at?
So basically everything is relative, Alex. So when you're investing in a full equity fund like a Nifty, replicating Nifty, or replicating a flexi cap fund like say the benchmark for which would be like Nifty 500, or a mid cap fund which is a benchmark would be Nifty mid cap 150 index. These three indices will actually have very different standard deviation. I wouldn't have the data handy, but I think a Nifty would have about 17-18% standard deviation. A Nifty 500 would be about 22%, 23% standard deviation. So basically having all your money in equity at all points of time will basically mean that you are actually taking that kind of risk on your portfolio. And hence, we always recommend that based on your risk profile, as we call it, as investor personality needy money app, and your horizon and your importance of the goal that you're investing for, the asset allocation or the portion you put in equity will determine the end results that you get as an investor. So you can't control the fund standard deviation, but you can control your portfolio standard deviation by actually having a diversified distribution into different asset classes of equity, debt, and gold. And if you do that, then even if you're invested in funds which are having these kind of standard deviations, as a portfolio, you will be actually able to control your standard deviation. And that's where investing becomes a very rewarding experience if you do that.
Speaking of diversification, I think it's also important to talk about debt. Uh, we don't have a lot of time, but could you very quickly tell our viewers the three aspects to pay attention to when it comes to debt funds?
So one of the first things that no, we should expect from debt, or we probably should be investing in debt for, is return off principal and not return on principal. Many people actually tend to demonstrate same risky behaviors of investing when it comes to debt as they do in equity. And if you do that in debt, it can be very, very detrimental to your portfolio. If a debt fund falls off by 2-3 percentage points, it may take quarters to recover and come back to kind of a same level as you invested. Vis-a-vis a equity fund where a 2-3 percentage points, even a 5 percentage point fall may get recovered pretty fast, in a few weeks or few months time period. So you should always invest in debt fund which with a lot of safety aspect in mind. And there are ways to understand how safe that debt fund is. One of the ways is basically look at the interest rate risk in the portfolio, which basically comes from a kind of a parameter called modified duration. So if you are investing in a fund whose modified duration is say 3 years, it means that for every 1% interest rate rise in the economy, your debt fund actually can fall by 3 percentage points. And having that kind of fund at all times may not be the best thing for your portfolio. So look at interest rate risk in the portfolio. Second is the credit risk. So you should be investing in companies which actually have very healthy credit profile to return the principal back to the lender. The way when we approach banks in real life and are given the loans based on our credit score. Similarly, companies are given loans based on their credit rating. And if we banks are so kind of legitimately giving us loans and thinking a lot of doing a lot of deliberation, the same way fund managers should be doing a lot of deliberation in putting money in funds and in companies which have a good credit profile. So look for companies which have AAA rating and funds which are investing in AAA kind of companies. And third aspect of
Right.
debt investment is basically looking at do you actually have enough yield in the portfolio. So if the yield is actually very less and the modified duration is very high, then you may
Right.
actually suffer from a lot of risk in the portfolio.
Absolutely. I think we've covered quite a few aspects of risk and also how to select the right fund for your portfolio and for your financial goals. Thank you so much for taking the time, Santosh.
Thanks, Alex.